Well, welcome everyone as you join us.
Yes, welcome. Welcome to our program, The 5 Things You Need to Know to Retire with Confidence. And this evening we have some sponsors. In fact, we have some of the representatives from our sponsors here with us this evening. We'd just like to first say thank you, and then we'll give you all an opportunity to address your patrons. We have the Mason Bleakley Library, we have the Newington Library, and they have the Westport Library as sponsors this evening. So we have Ellen from the Westport Library and Karen from the Newington Library. We'll go ahead and let y'all say your welcomes, and then we'll get started.
Hi, I'm Ellen Jampol, business librarian at the Westport Library. And on behalf of the Westport Library, I'd like to welcome you to this evening's event. I'm sure you will find it fascinating about how you can live in retirement and prosper. Just for some future information, the next in-person event at the Westport Library is coming up this Monday evening, July 19th, when we will welcome The Link, a business professional networking group, from 5:30 p.m. to 7 p.m. It is going to be outside on the Riverwalk level, and everybody is welcome to attend. Thank you for coming this evening.
Thank you, Ellen. That sounds very intriguing outside on the Riverwalk level. Karen, how about you? We'd like to welcome your patrons.
Yes. Hi, I'm Karen Benner. I'm the Assistant Library Director at the Newington Library. Welcome to all you Newington patrons out there. I'm going to just say we have a lot going on this summer. We have virtual programs. We're doing some outdoor programs. So please either check our website or look at our newsletter, our footnotes. It has all the details for all of the fun and exciting things we have going on this summer. So thank you.
Thank you, Karen. Thanks again for your sponsorship this evening. And we hope tonight's program will be enlightening and helpful for those that have attended. We know that retiring is on the minds of a lot of folks, actually more than ever. It seems like the situation that has transpired over the last number of months has caused people to rethink whether they want to go back to work or not. So we'll look forward to helping folks learn how they can retire with confidence. I'm going to go ahead and start to share my screen here. There we go. So my name is Jody Goss. I'm with AAA Retire. We have also with us Bianca Noizu and Jeff Bauer. I'll go ahead and let them introduce themselves. Bianca Noizu is an independent financial planner that volunteers her time for adult education with AAA Retire. I'll talk a little bit about who AAA Retire is in just a moment, but Bianca, can you share a little bit about your background?
Absolutely. So I have just about 23, 24 years in financial services. So I've worked with individuals and families throughout the decades to help them plan for transition and get settled into a comfortable retirement. So I'm happy to be here tonight, and hopefully some of the information that I'm able to impart to you, you'll find helpful in your planning.
Thank you, Bianca. Yes, she's been in the industry quite a while. She doesn't have that appearance, the genes, obviously, right?
Thank you.
Jeff Bauer, a little bit about yourself. I know you're an independent financial advisor too that volunteers your time for adult education.
Yeah, thanks very much, Jody, and happy to be here. I have 25 going on 26 years of industry experience, 7 years as a planner. And before that, I was on the institutional side, helping financial consultants help individuals as well. So thanks again. Happy to be here.
Thank you. And my name is Jody Goss. I'm also an independent financial advisor. I've been in the business approximately 30 years and volunteer my time also for educating folks through the AAA Retire program. So who is AAA Retire? Well, AAA Retire is an organization that started back in 2003. It started primarily as a AAA member benefit, but as you could see, it's expanded to libraries, adult education, and other facilities throughout the state of Connecticut, primarily up and down the East Coast as well. We also do adult education for companies. So if you have a company that is interested in bringing education to your employees as an employee benefit. I'd be more than happy to talk about that with you. Tonight's workshop is about 40 minutes in length. We're going to take an overall view, some deep dive into some aspects of retirement, but really it's education and its outlook. We're also going to offer to you a number of resources, and as we go along, you'll see how you'll be able to claim those. Our faculty has over a century of experience in helping individuals. So myself, Jeff, Bianca are just three members of the faculty. If you can navigate to our website, then you'll see the entire faculty there under the team tab. So let's get right into it. Let's talk about some of the obstacles that retirees are facing these days. For many that are with us this evening, no doubt you can identify with that first one: elimination of pensions by companies. Retirement has become a do-it-yourself situation for most retirees. And the result is that unless you know what you're doing, you could really come up short whenever it comes to a lifetime sustainable, predictable income. And that's why planning for Social Security is so important. We're going to talk a little bit about that, the challenges with regards to planning for Social Security. But unfortunately, according to Kiplinger's, most retirees still claim their benefits before their full retirement age, leaving tens of thousands, perhaps hundreds of thousands of dollars on the table because of poor planning. Social Security without a pension is one of the only, if the only, a lifetime guaranteed inflation adjusted income that a person has. And yet most folks do very little planning whenever it comes to this. As far as retirement savings are concerned, a survey by NerdWallet showed that the average household in retirement saving has about $408,000, which is not too bad. But the median household has only $134,000. So, depending on your situation, having to save for yourself through volatile markets could create a significant challenge. But then once you get to retirement, creating a lifetime income with potentially persistent low interest rates and higher taxes, having to adjust for those could also present a challenge to a retiree these days. So we're going to dive into these a little bit more as we go along in the workshop this evening. But let's tackle the first one, Social Security. Bianca, why is Social Security such a challenge?
Oh, it's such a challenge. As you mentioned, Jody, and with the lack of folks having access to traditional pensions, the lack of sometimes adequate retirement savings, Social Security becomes that much more important. It's really the bedrock of income for retirees, but you only get one chance to get it right. So many people are confused about their options. In fact, the Social Security Handbook has over 2,700 rules and thousands of ways that you can claim benefits. It's a tremendous challenge for the average person to try to decipher them all. And that's why we do encourage you to get help in planning to get the most out of your Social Security benefits. There are a number of opportunities, but quite a few gotchas if you don't know what you're doing. And we have prepared our 22 need to knows before applying for your Social Security retirement benefits. We're going to be giving you the opportunity to claim this free resource at the end of our workshop this evening. But that's just one of the resources that's available complimentary through AAA Retire. Jody, can you speak to another one that our folks can request this evening?
Yeah, absolutely. So obviously knowing the gotchas, knowing the pitfalls is important, but knowing what is the best strategy for you personally. How would you know that with hundreds of thousands of rules, various ways, especially if you're married, to claim your benefits? Well, for those of you with us, we are offering a guide to help you know what the best strategy is. In fact, our motto is, why guess when you can know? Why guess when you can know what your best claiming strategy is? Because of the sponsorship of the library and our community outreach, we're offering individuals, no obligation, free of charge, a tool that will take your personal information, not your Social Security number, but just the income numbers, and take that if you're married and your spouse, or if you've been divorced, your ex-spouses, if you're deceased, your deceased spouse information, dilute all of that into your best 3 or 4 claiming strategies. Then you can make an educated and confident choice as to what your best claiming strategy is. In fact, here's an example of what that looked like. I know it's a little small here for you to see, but in this particular case, it was two spouses. The difference between claiming at the earliest and the best was $136,509. So once again, if you're interested in claiming this strategy, I'm going to go ahead and bring up a poll here. All you have to do is just let us know yes or no. And then once you submit the poll, we'll go ahead and launch it here. The question will come down. So simply just click yes or no, submit, and the poll will come down once it's been submitted. So let's talk about another issue that retirees face, a challenge, if you will. The challenge is that of longevity.
Jody, this is quite the challenge, isn't it?
Yeah, absolutely.
With folks living longer and longer, it's funny because longevity is a challenge, but it's also a benefit. This means, we're spending more time with our children, our grandchildren, maybe our great grandchildren, but it also can stress retirement assets. So retirement funds need to last longer than folks that maybe retired 20 or 30 years ago, because we can expect to live some 20 to 30 years in retirement, possibly more. Advances in medicine, people taking better care of themselves, have resulted in greater life expectancies. If we look back at some figures, interestingly, if you were age 65 in the year 1990, your life expectancy was 84 for women and 80 for men. So just in the span of 20 years, these figures have jumped from 89 and 80, or jumped to 89 and 87 respectively. And here's some other interesting stats. A couple age 65 today has a 97% chance of at least one of them living to age 75, a 75% chance of that one of them will make it to age 85, and a 20% chance that one mate will reach age 95. So again, it's a blessing to have this extra time with our families, but we need to position retirement assets in a way that's going to help weather the ups and downs of the economy, provide growth that's going to protect against inflation, but also generate a reliable, sustainable, predictable income in retirement. And that last point I mentioned, income is paramount in the mind of retirees. How do I turn a lifetime of savings into an income that will last for the rest of my lifetime? Definitely brings us to our next challenge, which is income distribution. Jody, can you elaborate on that?
Yeah, thank you. Excellent point there, Bianca. So the third challenge is that of distribution. What got you to retirement is distinctly different than what's going to get you through retirement. What you did to accumulate funds, especially over the last number of years, has most likely, if you've been saving in a 401k as an example, has produced really good and excellent results. But whenever it comes to distribution, there are a number of problems. So we're going to dissect a few of the problems here this evening. The first is that of how dollars from typical mutual funds are distributed. So typically in a mutual fund or a series of mutual funds, there's a prorated distribution, which means if we look at this pie chart, if you have a statement, you probably have a pie chart like this. The distribution is equal distribution amongst all the asset classes inside your fund. Well, why might that be a challenge? Perhaps the market is not conducive to liquidating equities or stocks at this time, or liquidating bonds at this time. But if it's prorated, there is no real plan for distribution. So that's one challenge, not having a distinct distribution plan. We call it asset location, not just asset allocation. But let's talk about the difference between accumulating and distributing for retirement. So let's look at an example here. It's a simple example, simple numbers, maybe a little exaggerated, but they're designed to help me make the math easy. Let's imagine that you're saving $1,000 a month for retirement. And at the top of a market, which we've all seen, you're buying your favorite mutual fund at $100 a share. So your $1,000 is buying 10 shares. the market goes down, you have the internal fortitude and discipline to continue to save, which is the right thing to do. Your $1,000 goes in. Now that mutual fund is selling at $10 a share, you're buying 100 shares. We know what happens historically. We've all experienced it. The market goes up and now your 100 shares is back to $100 a share. A very good thing, as Martha Stewart might say. We're all familiar with this. It's called dollar cost averaging. But let's take a look at the exact same example. And now instead of saving for retirement, we're distributing dollars for retirement. The same $1,000, except for now you're not saving it, you need it to live on. At the top of the market, you have to sell 10 shares to raise the $1,000. Market goes down. Your need for income hasn't changed. And for most, your strategy of how to get it hasn't changed. So now you're having to sell 100 shares to generate that same $1,000 a month. What's the significant difference? The significant difference is once those shares are sold, you don't have the benefit of a recovery. They're sold, they're gone forever because you took them and spent them to sustain your retirement. So as we can see here, what we're not doing is dollar cost averaging, we're dollar cost ravaging whenever it comes to taking dollars from a retirement account. But to bear this out even more in an actual example, Jeff, can you walk us through how this sequence of returns affects what we're talking about here?
Yeah, sure. Thanks very much, Jody. So we liken it to being a retirement coach or income for saving for retirement coach, and then distributing in retirement. Let's take a look at an example. So we've got two different couples. If you want to flip to the next. So we've got Jim and Mary, and we've got Bob and Barbara. And as you can see, both of them had very different experiences in investing. They both started with $100,000. They both ended with $285,000, and they both averaged 5.4% over the life of their investing. However, if you look at the sequence of returns that they had, it was very different. In the first 3 years, Jim and Mary were up to $160,000, and by year 4, $170,000. On the other hand, Bob and Barbara had a very difficult time in their first 4 years, and they actually lost money and were down about half. However, because they stayed the course, like Jody showed us, and when the good times came, they were able to rebound. On the other hand, Jim and Mary, they had some rough years in later years. As a result, they ended up with the same thing. For those of you who have high school students, it's called the commutative property of multiplication. It doesn't matter what sequence the returns come, as long as they're the same, you're going to end up with the same exact return. But now let's take a look at an example when they start distributing money. As you can see, Jim and Mary both take out $4,000 a year adjusted for inflation, the same as Bob and Barbara. That's the WD column, withdrawals. As you can see, as they're taking money out, Jim and Mary, because they had such a great first few years, they're still at $160,000 after 4 years. On the other hand, Bob and Barbara, because they were down 50%, they've compounded the problem by taking money out. As a result, when the good years came, they didn't have enough money still invested in the market to recover and would likely have to go back to work or find another alternate source of income because they ran out of money in their 14th year. Where Jim and Mary, yeah, they struggled with some of the returns later on, but they still ended up having almost $300,000. So you can see the sequence of return is one of the most important things to insulate yourself from in retirement. And by putting together a good plan, you can insulate yourself. Bianca, you want to talk to us a little bit about that?
Yeah, and just Jeff, thank you so much for highlighting that critical risk to retirees. It's not something that folks necessarily focus on. It's not front and center. But you know, I personally don't want my retirement to hinge upon the mood of the market. So retiring, you definitely need a properly constructed retirement income plan, like you said, and it should be reviewed at least annually. And in our planning, we believe that this plan should consist of three things. Money coming in every single month to cover your expenses. And that's why we start with Social Security, because for most people, that is their guaranteed lifetime retirement income. The second phase or segment is money in the bank, money that you can access readily without a penalty for home repairs, if you need a new car, if you want to take that wonderful vacation when it's finally safe to travel again. And lastly, money that's invested for the long-term horizon to help keep pace with inflation. But let's take a look. I'm gonna pivot back to you for a moment, Jeff. Let's take a look at one of the plans that you recently created for a family that really gave them insight into what their retirement would look like 10, 15, 20 years down the road. Can you enlighten us with that?
Yes, certainly. Now, I know the screen's a little bit busy, but basically what we've done is we've created a bucket approach. And it's actually funny for those of you who watch Market Watch. There's an article in Market Watch today that speaks to how good a bucket strategy is and how superior it is to the 4% rule that some of you might be familiar with out there. But the reason why we like the bucket approach so much is this. The first portfolio, or the red portfolio, you can see the growth rate is expected to be 1% of that. So really, that's going to always be there. It's always going to have 5 years worth of income for you, and it's going to be very conservatively managed, and it's going to be fed by the other accounts. And this is going to act like a paycheck to you, where it's going to be money coming into your account every single month, just like a paycheck, so that you know, regardless of what the market returns look like, that there's money in the checking account for emergencies or to pay bills. The black portfolio, or portfolio 2, is going to be a little bit more aggressive, but still going to be fairly conservative. And that's going to be to ensure that if something were to go wrong and we had a sustained downturn, you actually have about 10 years worth of income that you can rely on. Then portfolio 3 and 4 are going to be more aggressively managed. In this case, the husband was a little bit more conservative than the wife, and he wanted 4%. The wife wanted 6% in their retirement accounts. So what that allowed them to do is they stayed a little bit more aggressive, which allowed them to keep pace with inflation to ensure that regardless of what inflation looked like over the years, they were going to have enough money in future spending dollars. If you look on the gray line, and I don't want to get too in detail here, but the other income line. So a couple things that we had talked about earlier. We talked about pensions or Social Security, and I would put pension or other income in that column. So you know what you're getting in from your Social Security. You know what you're getting in from your pensions. The portfolio income is going to be that money that comes out of that red bucket that you know is very conservative, that meets the total goal. So for this client, they needed $141,000. And as you can see every single year exactly where money is going to come from, adjusted for inflation, to meet their goals. And basically what this plan does, and any good plan that you're meeting with a planner or talking to somebody about, should have all of these components. It should have your Social Security. It should have your pension and any other income. It should take into account longevity. It should take into account where are the distributions coming from? How do you protect from sequence of returns? And that's basically what this lays out for you. And any good plan that you meet with anybody should. So that's the plan that we like to run. It's called the bucket approach. Back to you, Bianca.
All right.
Actually,
I think, Jody, are we going to give
yeah, we're
folks
going
an
to give everyone
opportunity?
to get their own personalized retirement income plan. One thing I think that's important, because this is educational, this plan does not make any investment recommendations. It's investment agnostic and simply projects conservative rates of return so you can see what the future looks like. So if you would like to have that report, go ahead. The poll is launched. Go ahead and take your time there to answer yes, no, and submit it. Then the poll will come down. All right, Bianca, you want to talk to us about additional issues that we face in retirement?
Absolutely. Sure. You give the girl the emotional slide to talk about. So this is a very real risk that we challenge that retirees face, that anyone really faces, and that's the emotional roller coaster of investing. At times, it can feel like a roller coaster to weather the ups and downs of the market. But letting short-term erratic movements of the market, they can create anxiety and push investors into making unsuitable decisions. We can see here on this slide that investors go through a whole cycle or a range of emotions depending upon market movements. They feel confident, even euphoric when markets are high. They may even be overconfident, wanting to, just let's buy. But this presents some risks to investors, because when the market cycle changes and the economy tightens, investors are no doubt going to feel nervous, desperate, and sometimes defeated when markets pull back, and the cycle continues. So next slide, please, Jody. So we'd like to highlight why it's beneficial, and we'll touch on how in a little bit, but why it's beneficial to take emotion out of your investing strategy. This chart shows how making emotional decisions and knee-jerk reactions can hinder the performance of a portfolio. As you see here, going back from 1997 to 2016, all of these areas fared better than the average investor return. So real estate investment trusts, the stock market, gold, bonds, international equities, oil, and home sales, their overall returns beat out the average investor returns. Why? Because likely the average investor did not stay invested during the entire time period. And so in general, sometimes people let emotions affect the way that they invest. And instead of staying invested for the long run, they tend to buy high and then panic and sell low. As a side note, you'll likely notice that this slide shows the performance of these investments, such as gold stocks and real estate, which performed very, very well during the last 20 years. It doesn't necessarily mean that you should dump all of your eggs in one basket. So just keep that in mind. But the returns that you see here are averaged over a long period of time. And all of these investments have seen ups and downs through the years. So for our planning purposes, we do think that a well-structured portfolio should contain a variety of investments based upon a client's objective and their personal tolerance for risk. So let's talk about risk a little bit. It's crucial that investors take their own personal risk tolerance into consideration. And that's why it's so important when we work with clients or build out portfolios, we always do an in-depth risk analysis with them. We want to create a plan that they're going to be comfortable with, and but still has the most robust recommendations. But ultimately, if the client's not comfortable with it, it is not going to be successful in the long run. So I challenge you, looking at this slide, think about where you may fall. Do you need modest but consistent returns? Do you want to shoot for the moon and can emotionally handle the ups and downs? Or do you fall somewhere in the middle? This is all things that you need to think about in constructing a retirement income plan. Selecting a suitable combination of investments to meet your objectives is extremely important. Multiple studies have shown that asset allocation is the primary factor that influences volatility and return in a portfolio. We've also discussed asset location as well. So a 1991 study showed that asset allocation was responsible for more than 90% of a portfolio's movement over time. And a similar study in 2012 repeated those results, showing that 88% of the portfolio performance over time could be attributed to the mixture of the assets in the portfolio. So bottom line, it's not about picking winners or jumping in and out of the markets that determines your long-term investment outcomes. It's picking the right mix of your investments for your personal situation.
And so we prepared a ebook, How to Avoid Retirement Risks and Uncover Unique Opportunities, that takes a deeper dive into some of these risks we just talked about. At the end of the workshop, you'll get a chance to claim this resource, so stay tuned for that. But let's talk about risk number 5, challenge number 5, potential for low interest rates and higher taxes. Jeff, why would that be the case?
Yeah, thanks very much, Jody. A lot has changed, to say the least, in the last couple of years. The pandemic shutting down basically the world, right? And us all staying at home. But a couple big things have happened, particularly in this country. The biggest one is the massive amount of spending that the federal government has done. It is so much, in fact, a recent Forbes article wrote that because of the pandemic, the federal government is running a higher deficit percentage of GDP than we've seen since World War II. After World War II, when you think about how many planes and aircraft carriers and missiles we bought, we were basically at a 1-to-1 ratio, GDP versus our debt. Today, our debt is approaching $30 trillion and our GDP is about 21 trillion. So we have about 150% of our GDP right now, or debt to GDP ratio. So the point is, at some point in the future, regardless of whether you're a Democrat, a Republican, a red state, or a blue state, we're gonna have to come, to the table and figure out exactly how we're gonna pay for that. Jody, if you wanna switch to the next slide. This is a great slide. It just shows, we thought that when Bill Clinton left office in 2000, we had $5.6 trillion in debt. And I lived in New York City, and there's a big billboard that shows the debt and just how much each person owes on it. And it's staggering to think that today it's almost 6 times that amount 20 years later, which just underscores what we're talking about. And the point of this is the federal government just can't afford to have interest rates go up. The reason being, if interest rates go up, we simply can't afford to maintain or to continue to support the debt level that we have. So we're likely to see rates stay low. I know a lot of people are talking about inflation out there right now, and rates need to go up a little bit. And that is probably true, but I think you're going to see them stay sub 3 to 4%. Remember, rates back in the 70s got up into the 17, 18%. So I don't think we're going to see any type of inflation like that. As a result of that, there's been a couple big changes. The one for investors is going to be the Secure Act. Do you want to switch to the next? Thank you. So we like to say, before the Secure Act and the amount of debt that we built up, investing for retirement was pretty simple. When you inherited an IRA, you could take a lump sum distribution, you could do it over 5 years, or you could take a lifetime of distributions. And this is just for an inherited IRA, mind you. However, with the Secure Act, the federal government took away that lifetime distribution. You now have to have a mandatory distribution of all of the assets within 10 years. That doesn't apply to spouses. It's only for non-spouse inherited IRAs. So when it comes to the kids, or when you inherit one, it could create some problems for the person inheriting it in terms of how much income they will have at a given time, and not being able to control when they take those distributions because of the 10-year rule. It's also going to create some problems with trusts. If you do have a trust, you might want to discuss it with your trust and estate planning attorney. If it's a conduit trust or an accumulation trust, there's a big difference. A conduit trust may create a problem because it states that any distributions or RMDs, which the required minimum distribution is what you must take out of an inherited IRA, must go to the beneficiaries of the trust. It cannot stay in the trust. So basically what the federal government has just done is they've said, if you have a conduit trust, you need to liquidate it entirely within 10 years of inheriting that trust. On the other hand, if you have an accumulation trust, it allows the trustee to build up reserves inside that account and they don't necessarily have to pay out those assets. They can stick to what the original trustees had intended in their verbiage of how they wanted the trust to be paid out to the beneficiaries. So I would take a look at your trust and make sure that they still do what you intended them to do. So I love this slide, the thinker. Is there anything you can do? And the answer is yes, but you're going to have to get your team together. So you really want to have a CPA that's working in concert with your trust and estate planning attorney, as well as your financial consultant. I love the chess checkers analogy because the boards look the same. The pieces, though, move very differently and they do very different things if you're familiar with chess, which actually became a big deal during COVID. But the answer is you can convert some of the assets to a Roth, whether it's done in a lump sum or on an annual basis. There's certain whole life policies or long-term care that may be appropriate, certain annuities. You may want to start gifting in life, so there's not that 10-year minimum period. You can even withdraw assets from retirement accounts, because remember, the assets that are in a retirement account are going to pass totally different than assets that are outside of a retirement account. So there are a few ways, but you really need to get together with your financial consultant, your CPA, and your trust and estate planning attorney to make sure that the wishes for your money are being sustained and held up to.
So Jeff, can you tell us in conclusion, how does a retirement coach, how to bring all this together?
Yeah, so, I would go back to, you've got your 5 basic problems that you're facing, right? You've got Social Security, you've got longevity, you've got distribution, sequence of returns, and possible higher taxes and lower rates. A good income coach should help be able to create a plan for you and walk you through those 5 things to ensure that those issues don't become an issue, or if they're an issue for you, you will see it coming. And that's why I love the plan that we have so much, because you'll see it 10, 20, 30 years out that it's going to become an issue, and you can take steps to change it long before it happening.
Yeah, and obviously organizing a plan and then monitoring that plan for its ongoing success. So once again, everyone that's with us this evening, just in summary, we'll bring a poll back up again. You're able to claim our 22 need to knows, our Social Security personalized timing report to help you determine what is your personal best strategy, the retirement income report to help you look into the future and see what the future of your retirement savings looks like as it relates to withdrawing as opposed to accumulating. And then finally, our How to Avoid Retirement Risks and Uncover Unique Opportunities ebook. Once again, everyone will be able to go ahead and claim that here in our final poll. So I'm going to go ahead and bring up our final poll, and you'll be able to claim those strategies. Let me just bring that up.
I would actually encourage anyone, if you have friends or family that you think this may be helpful to. I know we recorded this, so they can obviously go to the library and watch it. Hopefully we'll be able to get that set up, or if you want to refer them directly to us, we'd be happy to discuss it with them or get them those reports as well.
Mm. And I'll throw one more thing out there too. These are just some of the resources that we have. I invite everyone to visit our website, AAAretire.com, where we have numerous additional resources that can help a retiree.
So go ahead, the poll's launched there. Let us know what you'd like. You can select any and all of these. Jeff, Bianca, can you tell the folks how they'll get this material that they're requesting?
Sure. So what will happen is in the next couple of days, someone from our team will reach out to you to just confirm what you have requested and to answer any follow-up questions that you have from our workshop. If you've requested our Social Security claiming guide or the income report, we will need to collect some basic information from you to be able to run that report. But we will be reaching out within the next couple of business days.